Hey, Investor B, I want to invest in stocks. How to go about it? Do you know fourth grade maths? Obviously, I do. Then you can invest in stock markets and even beat the 70% of the fund managers. 70% of the fund managers? I can't believe you. Don't believe me. Believe Peter Lynch, the star fund manager of Fidelity Investments, who delivered returns of 29% CAGR from 1977 to 1990. In his book, One Up on Wall Street, he says an individual investor can beat the pros in their own game. But how? This is how. Peter Lynch tells four major reasons of this. Street lag. Small companies are generally out of radar of mutual funds, as they won't move a needle in a big mutual fund returns. Unless they become big, they are often ignored. We can buy at initial stages of expansion until big institutions get into it. This is often known as street lag. We may have generated multi-bagger returns before any fund manager. Accountability. If a fund manager is invested in a company such as Netflix or Amazon and its share price falls, then the question of what's wrong with Netflix or Amazon will pop up, as one is expected to be invested in. But if a fund manager is invested in a company such as Micron and its shares falls, then what's wrong with the manager will be asked. Fund manager do not want to look foolish. It's better to be an error rather than being called a fool. We can actually do the opposite and can generate better returns. But we have to be right. So, regulations. Regulations prohibits mutual funds from investing in companies which may have unions, which are in non-growth sector, or even public sector companies, where government is the promoter. We can invest wherever opportunity exists naturally and can make exceptional returns. I actually made 140% return in a public sector unit. Thinking out of the box. Unlike a fund manager, we do not have to worry about quarterly performances of stocks. We do not have to explain to anyone for hours why we bought, why we sold. We do not have to own 100 stocks or even 50 stocks. We can concentrate our investments in few stocks, and there is enough data to prove that concentrated, high conviction bets can generate higher returns than an average mutual fund. Let's look what more Peter Lynch has to say. He divides stocks in six categories. The slow growers. Companies which grow at the speed of GDP or a little faster than GDP are considered slow growers. Large aging companies lie in this category. Generals, utilities come in this category. Light, water, railway companies, etc. What do you think about a tobacco company? Are they slow growers? I'll leave this question to you. Comment in comment box. Do let me know. Charts of slow growers look like this. You can easily figure out a slow grower. The stalwarts. Companies that can grow faster than slow growers but can't be considered high flyers lie in this category. Companies such as Coca-Cola, Procter and Gamble, Hershey's, and Colgate-Palmolive are example of stalwarts. The charts of stalwarts look like this. Can you guess the name of the company? Berkshire Hathaway. The fast growers. If a company can grow 20 to 25% a year, then you can call it a fast. It can give you 10, 20, or even 40 baggers. It does not necessarily be in a fast growing industry. All it needs is space to expand. Consider the example of Tesla. Let's check its financials and charts. You can see it has grown its revenue from 21,461 billion US dollars in 2018 to 81,462 billion dollars in 2022. Almost four times its 2018 revenue, Although autos are not considered high flyers, but Tesla has grown its market share, so this can be considered as high flyer. Its current market share in electric vehicle is 50.58%. Cyclicals. These are companies whose profits and sales rise and fall regularly. Autos, cements, steel, airline, and tire companies fall in this category. These companies perform well when economy flourishes and fare badly in a down economy. Don't consider Tesla as cyclical. We have seen it above. Turnarounds. These are companies which are not considered as investments by general market participants. These type of companies doesn't have earnings. They don't seem to have future. They have broken balance sheets. But if these companies survive the bad times and start performing decently, you can get a handsome return. Asset plays. If a company is trading in the market below its net worth, then you can buy it, hoping the market will correct its previous assumption. Ben Graham was famous buying companies below its net worth and sometimes below the liquidification value. I don't think in these times you can find companies below their liquidification value, but you can definitely find companies below the book value. Now, let me show you how Peter Lynch picks a 10 bagger. Peter Lynch would select a company with no competition, even with mediocre management, over a company with a high competitive environment with highly skilled management. He says that one day an idiot may eventually run that business. Therefore, it is important to get the business right more than the management. He looks for simple and understandable business. He gives 13 descriptions for a 10 bagger. I would tell you the most important ones. It sounds dull. He says companies that have potential to become 10 baggers often have a dull name. This makes them unpopular. Hence, price of its shares are depressed and have potential for big gains. It may be a spin-off. When big companies spins off their divisions, the spun-off divisions are generally better managed by new managements. They even have better balance sheets, but they are generally overlooked because of the investor's psychology attached with previous company. The institutions and analysts don't follow it. Due to various reasons, as we have discussed earlier, institutions don't own it and companies' shares have potential for big gains. It's got a niche. Companies that are focused on specific product or business segment are destined to give better results in the long run. This niche helps them to get bigger and wiser with time. The insiders and company is buying back shares. One of the signs that company will create value for shareholders is that insiders are buying it. They have full faith in the company's prospects and management in turn would want share price appreciation. Stocks Peter Lynch would avoid. Peter Lynch would avoid stocks which would be the hottest. These stocks have moved up a lot merely by speculation, and retail investors are making money in this, soon to lose it all. He would avoid the next something stock. If people start talking about a company that could be next Microsoft or Amazon, he would be alert. People generally follow the share price in the short term and start calling a company the next big thing without looking at its financials and business prospects. He would avoid companies which make acquisitions at unreasonable prices. He suspects that the companies tries to hide the deteriorating business by acquiring other businesses in different fields. These are the sort of companies one should avoid. Let's see how Peter Lynch buys and sells stocks. After figuring out in which category the stock falls, he looks at the PE ratio of the company. PE ratio is the rough idea whether the stock is undervalued or overvalued. The next step is to know as much as possible about the company and how it will bring the added prosperity. Peter Lynch would often call this a story. To get the story right, one has to look for the right management and financials of the company. But how can one get to know about the management? Here are a few ways. You may call the company. You may visit the headquarters. You may even get in touch with investor relations directly or through email. And what about the financials? For this, you need to dig deep into financials. Let's understand a few of them. Cash positions. Sometimes market tends to forget to calculate the cash per share a company holds in its balance sheet. There are many cases where price of shares becomes so depressed that if you figure out the value of share after deducting the cash per share, you would buy the security at a price of peanuts. Peter Lynch did it and had the biggest position of his career when he invested in Chrysler. Price earnings to growth ratio. According to Peter Lynch, if a company is growing at 15% and has a PE of 15, then he would consider it as fairly valued. He calculates it as PE to growth. If a company is growing at 15% and PE is 6, then getting the ratio of PE to growth would give us 40%. Then he would consider that company to be at a discount of 40%. The debt factor. A debt to equity ratio is one of the most important factors Lynch watches out. Debt to equity less than 1 makes a stable balance sheet. A balance sheet with 4 times debt to equity ratio is weak and company may go bust in any bad period. He avoided companies with high debt to equity ratios. Hidden assets. Companies may have stocks, cash, land, gold reserves, gold mines, or even oil reserves, which are assets not shown on balance sheets. Peter Lynch would figure out such assets which make companies more valuable and would happily invest in such companies. Selling. Peter Lynch says that different categories of stocks require different ways to sell. Selling a slow grower. It should be sold when stock has appreciated by 30 to 50% and the fundamentals have deteriorated. Selling a stalwart. If PE of a stalwart goes way above its growth rate, then it's the right time to sell a stalwart. Selling a cyclical. When PE of a cyclical company is minimum and capacity utilization is maximum, inventories are piling up, and prices of commodities are falling, then it is the best time to sell a cyclical. Selling a fast grower. When PE of a company is twice or thrice the rate of growth of the company, the fast growers should be sold. Selling a turnaround. When debt has suddenly risen, inventories have risen twice the rate of sales growth, and PE is inflated relative to earnings prospects, it's the time to sell a turnaround. Selling an asset play. When the value of the company in the market starts quoting its actual value or close to its actual net worth, it's time to sell it. Let's recap. You can beat most of the fund managers. All you need is the right logic. You should know the category of stocks which you own. You can easily pick a 10-bagger. You can buy and sell stocks just like Peter Lynch and can generate 29% CAGR. Cheers, guys.